Welcome everyone to this webinar organized jointly by IGF and the Economic Commission for Africa. IGF being the Intergovernmental Forum on Mining, Minerals, Metals, and Sustainable Development, which is hosted by IISD, the International Institute for Sustainable Development. My name is Thomas Lasso. I lead our work on mining taxation, and I will be your moderator for today. It's a great honor to play that role and to be here with you today. So the way this webinar is going to be organized, I will have the pleasure in a minute of introducing our speakers. Then we will see a presentation about our latest publication on this topic, mining tax incentives for Africa's sustainable development. And then I will introduce our esteemed panelists who will help us shed further light into this important issue for the continent. In total, the whole webinar will be about 90 minutes. It will be recorded, so hopefully we can also play it so for people who missed some of it or who missed it entirely. One more point of logistics, this webinar is available in English with interpretation in French. So feel free to change your channel to French on the Zoom in the Zoom menu if you would like to. There will be a Q&A towards the end of the session, and for that purpose, you can use the Q&A function on Zoom. At any point during the presentation, during the panel discussion, you can ask your questions through the Q&A, and our panelists and our experts will answer those questions. So feel free to use it both in English and French. Some of us speak English and French, including myself, as you can probably hear from my accent. So please feel free to share all your questions and thoughts about this issue. We hope to have a constructive and engaging webinar, and thank you so much for joining us today. Without further ado, I'm going to give the floor to Dr. Alan Mukungu, who's our partner at UNECA. And for those who don't know him, Dr. Mukungu is an economist with a PhD from the University of Westminster. He has extensive experience at the United Nations. He has worked on the technical secretariat for the Mbeki high-level panel that produced the famous report on illicit financial flows from Africa in 2015. And at UNECA, at the UN Economic Commission for Africa, he focuses on curbing resource leakages and strengthening domestic resource mobilization across the continent. So please, Alan, I welcome you to say a few words of introduction. Thank you.
Thank you very much, Thomas. Good morning, good afternoon, and indeed good evening, wherever you may be joining us from. Please allow me to stand on all protocols that exist for now. I'm delighted to welcome you all to this event, launching the publication of the Intergovernmental Forum on Mining, Minerals, Metals, and Sustainable Development, and the United Nations Economic Commission for Africa, themed on rethinking tax incentives in the mining sector in Africa. This publication has been long overdue, as Africa has struggled to maintain its positive growth trajectory since the beginning of this century, and is currently facing a significant annual financing gap, estimated at $1.3 trillion to meet the Sustainable Development Goals and progress towards its aspirations in the 2063 Agenda. Endowed with more than 30% of the global mineral reserves, including those that are vital for the global energy transition, there would be grand expectations of Africa benefiting much more from its mineral resources to close its sustainable development financing gap. Despite its mineral wealth endowment, many African countries face challenges in transforming these resources into broader economic development and prosperity for their citizens. Among the key challenges is one, to improve natural resource governance, promote value addition through processing and manufacturing within Africa, and ensure that benefits are more widely shared and inclusive. Yet, there is also a significant challenge of understanding and attracting investment into the mining sector to build these dreams. There is a significant cost of lack of understanding of the types, depth, and breadth of natural resources we have to facilitate strategic attraction of investment to build these dreams. For countries with natural resource endowments, one approach has for long been to provide tax incentives to companies to invest in them. This approach has also been fraught with challenges. Tax incentives, especially poorly designed ones, could significantly reduce government revenue, hindering the ability to fund essential public services, infrastructure development, and strategic environmental considerations. Incentives such as tax holidays, exemptions, and reduced rates that are intended to attract investment have more often than not resulted in substantial revenue losses. Where incentives initially have attracted investment, they have more often led to significant revenue leakage, particularly when they are overly generous or poorly aligned with development goals. Tax incentives have also provided opportunities for companies to prioritize short-term gains over long-term sustainable development, undertaking carousel contracts and potentially leading to premature depletion of resources and therefore reduced future revenue. As the current report shows, which it will be presented to us shortly, due to its globalized nature and complex operations, the mining sector is particularly susceptible to illicit financial flows through mechanisms such as transfer pricing and profit shifting, minimizing tax liabilities in resource-rich countries, and moving profits to lower or zero-tax jurisdictions. The UN Economic Commission for Africa's Economic Governance report of 2021 underscores the challenges African governments face in managing the resource sector, which, for instance, led to Tanzania's loss of more than 84 billion US dollars through illicit financial flows between 1988 and 2017. This was through base erosion and profit shifting by companies including ineligible costs and debt in determining profits, trade misinvoicing by misreporting the nature, amount, and value of minerals being exported, and the transfer pricing by collusion with other companies or associates to sell mineral ores at lower prices than actual market value. Illicit financial flows involving multinational corporations led to significant revenue losses for African countries, hindering their ability to benefit from their natural resources. Mirroring another study by the UN Economic Commission for Africa on tax expenditures in Africa, the current report we are going to be presented with today finds that while tax incentives are often seen as crucial for attracting investment, evidence suggests that factors like deposit quality, infrastructure, and political stability are more significant drivers of investment decisions. Therefore, looking at 10 African countries and considering only VAT, that's the value-added tax, and the corporate income tax, the UN Economic Commission for Africa's study finds that these countries lost the equivalent of between 4 to 76.5% of their realized total revenues in tax expenditures. Moreover, if the mineral is highly valuable, mining companies will inevitably invest in allocation regardless of whether there are specific tax incentives. Therefore, the perceived need for overly generous tax incentives may be overstated, and alternative strategies such as improving the overall investment climate and strengthening governance may be more effective. Ladies and gentlemen, in saying this, 5 years to 2030, Rethinking tax incentives requires a shift towards a more strategic and development-oriented approach, underpinned by rigorous cost-benefit analytics. This would require designing incentives that are time-bound, not only attract investors, but also contribute to the country's broader development objectives, such as job creation, local content development, industrialization, and infrastructure development. Such a design should include a monitoring and evaluation framework to ascertain the performance of the incentives and make relevant corrections in the overall time framework. It will also require greater transparency and accountability in the design and implementation of tax incentives to ensure that they are aligned with the Africa Mining Vision and contribute to Africa's sustainable development and the aspirations of the African Union's Agenda 2063. Rethinking tax incentives in Africa's mining sector is crucial due to potential revenue losses, the risk of illicit financial flows, and the limited effectiveness of poorly designed incentives. Rethinking tax incentives in the mining sector, therefore, is not about eliminating them entirely, but rather about ensuring that they are well designed, effectively implemented, and aligned with the country's broader development goals. This includes strengthening tax administration with better understanding of the sector's requirements, promoting transparency and accountability, and fostering a more equitable distribution of mining revenues. Following ECA's publication of its report entitled A Framework for Assessing and Reporting Tax Expenditures in Africa, which called on African countries to review their tax expenditure policies, Ethiopia asked for technical assistance in measurement of tax expenditure, which was provided, and the country later estimated how much the government was losing through tax incentives. The outcome of this exercise prompted the government to pass the Ethiopia Investment Directive 2025. This we are proud of because this only started last year, and this year there has been a result. Therefore, ECA stands ready to work with other partners such as our partners IGF to support other countries on request to achieve such reforms. With these baseline views, I'm greatly looking forward to the presentation of the report and the reactions from our panelists and all of us on this forum. Thank you very much.
Thank you so much, Alan, and I'm glad that you shared a specific example toward the end to show how reform can be achieved and results and with actual results for countries. So thank you so much, and thanks for your kind words as well, and for introducing this webinar. So I am now going to introduce my own colleague, Viola Terrace. So she works for the IGF in the Global Mining Tax Initiative. She has years of experience in the taxation of extractive industries. She's an economist by training. She's piloted quite a few interesting projects to rethink the future of taxation in Africa. So I'm sure some of you have seen her and engaged with her in that process as well. So I'm glad she contributed to this report, and she's going to present some of the main findings today to introduce the panel. So Viola, I hand it over to you.
Thank you so much, Thomas, and good afternoon, everyone. I'm going to start off by sharing key definitions and categories of tax incentives that are commonly used in the mining sector. And thereafter, I'm going to share some key highlights of the reports and direct you to go read about more in the report by looking, we'll share with you the link at the end where you're able to access the report and read a bit more in details. So what are tax incentives in the mining sector and where they're found? So incentives in the mining sector are normally found in two documents. So they would either be found in the legislation. So key legislations that affect the mining sector include the Income Tax Act, the Mining Act, and we also have national investment laws. On the other hand, in some jurisdictions, we find that incentives can be found in contracts. So mining contracts, which are normally signed bilaterally between the investor and a country, the government, or we also find incentives in international tax treaties. So these incentives, we're going to focus on tax incentives. There are other non-tax incentives that are commonly used in the mining sector, but for the purpose of this report, we only focused on tax incentives, which generally provide favorable deviations from the general tax treatment that is applicable for all corporate entities. So you'll find, for example, one investor has a tax incentives while the others do not. But also in some jurisdictions, we found that a category of investors are given incentives while others are not. So for example, in some countries, you'll find that large-scale mining companies would be given incentives, whereas small-scale mining companies are not eligible for certain incentives. Within the incentives category, we normally categorize them into two. So incentives could either be cost-based incentives or profit-based incentives. Cost-based incentives either can reduce the amount of capital costs for the investor. So for example, an exemption of import duty. So this reduces sort of a component of their capital cost, but also cost-based incentives would make the investor recoup their capital expenses quicker than would normally be applicable for. So for example, some countries have accelerated depreciation, which in essence doesn't reduce really the capital cost, but it allows them to allows the investor to quickly recoup this cost and later allow them for profits to trickle a bit later. So that's the cost-based incentives, and key examples, as I've mentioned, like sort of exemptions on import duties, accelerated depreciation, VAT exemptions, investment allowances, and credit. Evidence shows that these are better suited for the mining sector. As you know, the mining sector is capital intensive, especially in the earlier years of the project during exploration and development. And so again, facilitating the investor to recoup this investment sooner would be more welcomed. And it's not, in essence, reducing the sort of the profitability, but you're allowing the investor to recoup their costs sooner. On the other hand, we have profit-based incentives. So for example, we have the income tax holidays, we have withholding tax exemptions on management fees, on dividends. We also have some jurisdictions that have export processing zones and also royalty-based incentives. So these ones reduce the amount of taxes payable on the profit. This category of incentives are associated with high redundancy rate and are ineffective at attracting investments. This is because profit-based taxes are self-adjusting. And this means that, for example, when a company is making a loss, they're not eligible to pay any form of tax. When a company is making less profits, they will pay less taxes. And also when in times of higher profitability, then the taxes would increase. So we find that profit-based taxes are in itself self-adjusting. So when you include profit-based incentives, they are in a way redundant and ineffective in attracting investment. And so what you find that when you give these incentives, you find that it is the profitable mines that may end up benefiting compared to marginal mines just because of the way they're structured. So these are the two sort of major categories of incentives. We have the cost-based and profit-based. I'll now highlight some of the key findings from the report. I've structured that into 4. So first, tax incentives have led to the loss of substantial mining revenues. Number 2, they're less relevant to attracting mining investment. Number 3, they have been a source of illicit financial flows from Africa and continue to be. And lastly, they have negatively impacted communities. Briefly on the first point, they've led to substantial mining revenue losses. And Alan has mentioned that in the report, we have concrete examples of how much countries have lost because of giving tax incentives. When we were doing this sort of research, we didn't find sort of a comprehensive assessment of the cost of tax incentives in the mining sector in Africa, but also in other regions. So this is lacking, but we find that some countries, and Alan has mentioned that countries are now starting to carry out assessments and be able to put a number of how much they've lost because of tax incentives. Tax incentives, if they are meant to be meaningful or useful, the benefits of giving such incentives should outweigh the costs of giving such incentives. What then we find is that in most jurisdictions, this is the opposite, that the costs outweigh the benefits, or also in some jurisdictions, they have not yet put a number because they've not carried out financial modeling or an analysis in the first instance to understand if the investor needed the tax incentives. If you look at some of the costs of giving tax incentives, most jurisdictions will just automatically focus on the direct costs, which is the revenue foregone. But also based on our research, we've realized that there are other indirect costs that a country can occur because of giving incentives. Number one, administrative costs. When you have the tax administration being able to sort of compile and to review this cost, this comes with a cost. There are also other environmental, economic, and social costs from giving such incentives, and the other indirect cost, and I'll come to it in a few slides later on some of the behavioral distortions that we see as a result of giving tax incentives. Jurisdictions should also take into consideration the benefits of giving tax incentives, so considering the direct benefits, but also the indirect benefits, such as, for example, employment, skills development, that can be attributed to giving incentives. Again, as I mentioned, most countries do not carry out a cost-benefit analysis. Some only focus on the direct and indirect costs and benefits, which shouldn't be the case, that there are a lot more costs and benefits that we envision from giving tax incentives. It's more cumbersome to be able to put a number on the indirect cost and indirect benefits. And so in a way, it's very hard to countries to assess really how much in terms of revenues they've foregone from giving tax incentives. In the examples we've highlighted in the report, some of the costs or the incentives that have been given, we've seen that their magnitude could be equivalent to some of the country's budget deficits, and also some of the program or service programs, including sort of healthcare and education facilities. And so we see a need to really rethink these incentives, especially where most economies currently are cash strapped. Second point, we see that, again, evidence suggests that the mining sector is less responsive to tax incentives. And this is because the mining sector, we say, is location specific, while other industries like manufacturing industries are considered mobile industries. They respond better to tax incentives. Mining, being location specific, is not as responsive to tax incentives. And this is because you cannot move a mine from one location to another where, for example, the jurisdiction offer better fiscal regimes, or they offer tax incentives. Again, a study has been carried out, and this is highlighted in our report, that actually investors, one of the biggest things that they consider while investing in a country is geology. So 60% of the decision is based on the geology of that country, and that makes sense. Infrastructure, the ease of doing business, trust, stability comes next, as well as taxes. And so what we have seen, just by merely giving tax incentives, in some countries, it does not make up for some of the other weaknesses that we continue to see in some countries. And so tax incentives alone will not, for example, increase investment into the country. You have to consider all the other factors that we've highlighted below on this slide. And most specifically, geology is one of the biggest sort of driver of investment within the mining sector. Third, we've seen, and we've highlighted a bit more in the details in this report, that tax incentives have been a source of illicit financial flows. So one of the things is that, as I mentioned, that normally when you sign agreements with investors and give incentives, you envision a cost for these incentives. Again, based on our research and discussions with jurisdictions, these costs have sort of gone up, because it can trigger some behavioral response, which leads to additional tax avoidance that was not envisioned before. And so again, we rank these incentives and we see which ones have a higher risk of abuse, which one potentially could lead to tax avoidance. And it's really the profit-based incentives, which at the start I mentioned that these ones are less responsive or are redundant, especially in the mining sector. So these are some of on the slide before you see that income tax holiday, the economic processing zones are highly distortive or would easily trigger behavioral responses from investors, which leads to a higher tax avoidance than one that was initially envisioned. And meaning for countries that give such incentives, it might be good to direct more resources to be able to administer these costs, administer these incentives, because there's the potential for them to be distortive. And I'm going to show you in this slide, for example, an example of how an income tax holiday can be distortive and lead to more losses than what was envisioned. So for example, a jurisdiction might decide to give an income tax holiday. So for a period of time, this means that an investor will not pay taxes for corporate income tax for a certain duration. What it may trigger from an investor perspective is that in the period where the company is not paying taxes, a corporate income tax, they will try as much as possible and shift profits into that period where they're not paying tax. So this could be they would easily, quickly extract as much as possible within the tax-free period, but also extract the highest grade of the commodity, what we normally call high grading. So you find that because of giving this incentive, it has triggered some response from an investor, which leads to additional losses that was not envisioned when the incentive was being given. What we've also seen that it can trigger some abusive transfer pricing, and this is especially where you find an investor has one or more than one project in a country, or more than one mine, operating more than one mine in a country, and all these mines have tax exemptions that start and end at different times. So, for example, when one mine with the income, the tax-free period has ended, they could easily shift the profits from that to another mine that is already or continue to enjoy tax exemptions. So that's also a transfer pricing abuse, or that comes in by giving such incentives. So it's very important that while countries are looking to give incentives, to keep in mind that there may be some behavioral response that might be triggered by giving such incentives, but also to put more resources to be able to administer and to see if the intended or the able to account for the costs of these incentives. Thirdly, still on illicit financial flows, we also were able to look at other regions. So in addition to Africa, Asia, Latin America also give tax incentives. But what was what we noted, especially for Africa, is that African countries continue to give a lot more tax incentives in contracts. The disadvantage of giving incentives through contracts first is that it escapes public oversight. And in some jurisdictions where these contracts are public, they're normally public after all the terms have been agreed on. So there's no opportunity for public input. There's no opportunity for accountability from the public. Again, we say that the resources are being held by the government for its people. And so as much as possible, the communities, the citizens need to be involved. So by giving incentives through contract, then these agreements are signed into and normally would escape the public oversight. And so there's potentially for deals that are made that would lead to corruption in some jurisdictions. And so you find that you'll find it even becomes difficult in terms from an administrative perspective. For example, the Revenue Authority have to administer or able to follow through incentives signed in multiple contracts that have different types of exemptions. So it also becomes burdensome from an administrative point to administer incentives through contracts. And so our advice has been to move incentives from contracts to legislations where there's a clear sort of reasoning and objectives behind the incentives and are applicable and they're open to everyone. And then on the last point, we've also reported that really incentives have negatively impacted communities. Again, we say, and we continue to see that in jurisdictions that communities bear the biggest brunt of having sort of mining activity. So they are affected both economically and socially. And so there's a bigger drive for the communities, especially that surround the mine sites, to really benefit from the mining sector. Here we see that incentives can act or can impact the communities in a negative way, especially if the incentives are given on those subnational taxes that would normally trickle to the subnational government or the communities directly. So again, our advice is to not give tax incentives on subnational taxes, because these are taxes that would go directly to the communities. We've also seen that in some jurisdictions that you find that incentives would be given to foreign companies and not domestic companies. Domestic companies, this would involve, for example, small-scale mining, artisanal and small-scale artisanal mining, which can be a barrier for their investment opportunity, and also it prevents for the local community from benefiting, because those are the ones who make up the bulk of the small scale and artisanal small scale mining. And lastly, we can see in some jurisdictions that really tax incentives can impact communities in a positive way when they are targeted or linked to specific outcomes. For example, to encourage investors to adopt gender-responsive programs, but also to encourage local hiring, training, and technology. So there is a way that really incentives can go directly to positively impacting the communities if they are structured correctly. And I'm on my last slide, really on what are key takeaways from the report, and we highlight them at length when you look at the report. That first, the countries should rethink the use of tax incentives. We've seen that the incentives, if they're not structured well, they end up not being efficient. There are some tax incentives that are not geared towards the location specific of the mining sector. And so if countries continue to give incentives, they need to ensure that they're time bound and not over the duration of the contract. They have to be targeted to a specific need. If it's to improve technology, to adopt gender responsive programs, they have to be transparent and grounded in a demonstrable development need. Countries should consider conducting cost-benefit analysis to be able to see that the incentive has actually achieved its objective, but also to encourage the tax administration to continue to administer to improve and strengthen accountability of these tax incentives. A big point is on the regional coordination. We have seen a lot of jurisdictions try to compete for tax incentives so that they can get the biggest of investment to the country. That era of tax competition is long gone, and we'll have one of our panelists who will go into the details of why tax competition is no longer the case with the global minimum tax introduction. And lastly, again, countries should undertake a strategic review of their tax policies and incentives to align with the African mining vision. We see a lot of countries now are looking to increase value addition along the mining value chain. And so it's very important to consider what tax incentives, which are normally given in the upstream component, might deter such value addition from taking place, but also how can some tax incentives be used to achieve the objectives of increasing the value of the commodities across the mining value chain. Tom, I'll stop here and hand it over back to you.
Thank you so much, Viola, for this overview of the report. As you can see, it is very rich, and I'm sure it will be very useful for everyone here. So I encourage you to download the publication. You have a QR code here to download it directly from your phone. And we also shared earlier in the chat the link to the report. So please download it. It's only in English for now, but we're working on the French translation of the report. So in the coming weeks, it should be available on the same using the same link. Thank you so much again, Viola. And so now we're moving to the second part of this webinar with our panel discussion. And we have a very esteemed panel that I'm very happy to introduce now. It's made up of experienced and diverse experts with different views that are going to help us dive a bit deeper into the issue of tax incentives and what can be done to reform them when necessary. So let me introduce our three panelists. We have Mr. Edward Shabani, who's a principal planner at the Ministry of Mines and Mineral Development of the Republic of Zambia. Edward is a senior civil servant with over 22 years of experience across different government ministries in Zambia. And he has advanced degrees in economics, strategic development and development studies, and he brings expertise in planning, international economics, and policy development. Welcome, Edward. We have Gloria Machiga, who's a policy officer on natural resources and sustainable climate finance at the Tax Justice Network Africa, TJNA. We're happy to have Gloria with us today. So she leads the work of TJNA on tax, climate finance, and natural resource governance. She advocates for fair and transparent tax systems in Africa's extractive sector, engaging with regional and continental processes to address climate change, climate-related challenges. And welcome, Gloria. And last but not least, we have Kutsai Mataba, who's also a colleague at IISD. She's a policy advisor on tax incentives and sustainable development. So she specializes on international tax and investment policy for developing countries. She's a trained lawyer, and she helps government design investment incentive frameworks that promote sustainable development. Welcome, Kutsai. We're happy to have you with us today. So let me ask a few questions to panelists, and at any given time, feel free to ask questions in the chat, in the Q&A, and we'll address those to the panelists as well. So I'm going to start with you, Edward. Thank you for joining us today. So you have, as we've established, you have extensive experience in government in Zambia. So from your perspective, based on your experience, would you say that tax incentives have been effective in attracting mining investments in your country?
Good afternoon, and I'm happy to be here. I had some difficulties to join, but finally we are here. Well, I think the answer is a yes and no. First of all, I want to thank Viola for such an intensive discussion into some of the ramifications that the mining industry, especially in Zambia, have faced. So first of all, I'll give you just an analysis of where we're coming from. So in the First Republic, during the First Republic under KK, or Kenneth Kaunda, we had nationalized the mining sector. And then we started to privatize, the mining sector around 1991, now giving them into private hands. And then we saw a government that gave in a lot of tax incentives, as clearly indicated. And that was in the hope of bringing what we call, efficiency and effectiveness in terms of how, the mining sector should operate. That gave birth to what, Viola is just trying to talk about. First of all, reduced revenue for, the treasury. And also you discover that private sector is all about profit maximization. So that then entailed that now you have to reduce the workforce, from parastatals which were owned by government, to ensure that there's some effectiveness in running these mines, introduction of technology, very good, like the costs and the benefits that Viola spoke about. But that gave birth to social ills. You had a lot of increased unemployment, that then has to eat out of the national treasury because government then has to give social facilities for these people, increased theft, that were not known in the mining sectors and all that kind of stuff. So, and then that has continued up to now. And the disease that every other African country, suffers from is this, insatiable appetite to attract investment. And what I've seen, and I'll speak as a civil servant as well as as an expert in economics, is that they are also the benefits outweigh the costs. The costs have been that in the mining sector, for example, we are exporting good mining, copper, with 800 metric tons to 1 million metric tons. We are hoping that we're going to have 1 million metric tons today. The benefits cannot be seen, because we are only getting 10%, for example, in terms of taxation, from the mining sector. And what we're doing is that we want to increase that benefit that we're getting in terms of taxation through what we're calling local content. But there's a new dimension which has come because of this appetite to attract investment and giving tax incentives, is that now every other company, because we give to one company what is good known as stabilization agreements, which is basically incentives to the mining sector. That now has just made every other mining company queuing up on our doorsteps to have stabilization agreements. And in those stabilization agreements, they are trying to propose, if you look at one that we have from, one of the big mining company, and I hope this is a safe space, called Mingomba. What they are suggesting is that we had, a technical team from different ministries, and when we looked at that document, we discovered that we're not getting anything. But what are we trying to do is that we are trying to give in so much just to retain, for the purpose of creation of employment, or the mining sector to get the output increased and all that kind of stuff. So to answer your question, I think I will base it more on what Viola spoke about, and I think the costs outweigh the benefits that we have gotten in terms of giving these tax incentives. And I think that is why we are trying to ensure that we registrate, and I'm just coming from a meeting where the Minister of Mines has, of course, we have received a lot of back and forth from the sector, the chamber, the big companies, the IMF and World Bank about local content. We have put our foot down that we need to enact this local content law to ensure that we have increase in terms of revenues that we're getting from the sector. So I think that could be my quick response to what you have spoken about. And I can tell you that what we have done is what Viola spoke about. Again, I keep referring to presentation because it was very insightful, is that we have not registered the law, to ensure that these are the tax incentives. And I think in thinking about what we are talking about, stabilization agreements, we said, look, if we're going to have each mining company come to us and tell us we want these stabilization agreements, and we will give you A, B, C, D, and then the other one will come with its own needs and all that kind of stuff. We have made a decision that we are going to come up with a standard stabilization agreement, if that entails that we should go that route, which will specify the same conditions that will be given to these mining companies that want to have stabilization agreement. But the way to go is to legislate, so that there is always something that you'll be able to point to say, this is what is expected of me in terms of taxes and incentives for me to invest in this particular sector. I submit.
Thank you so much, Edward. That's really fascinating, and it's really interesting to hear. It's a bit of a mixed bag, and there are costs and benefits, and on the overall, you think that maybe a bit the costs kind of outweigh the benefits. I'm really also happy to hear you talk about stabilization provisions. Indeed, in themselves, they cannot often be seen as a tax incentive to mining companies, but they also have the effect, depending on how they're designed, of compounding some of the other tax incentives. They can make them last longer, be more durable than they would be otherwise. And so it's important to understand that interaction as well. And I'm sure we'll come back to this in the Q&A afterwards. I know a lot of countries in Africa are very interested in how they can reform stabilization provision or harmonize them, as you suggest, for Zambia. And actually, IGF published a guidance document earlier this year on stabilization provision. It's a very important issue. So thank you so much. I would say you say it's a safe space. It is a safe space, but the webinar is public and we are recording. So if you want to share examples, I invite you to. But maybe if you anonymize the company names, I think it's I would recommend to anonymize the company name just to be on the safe side for your government. So I'll turn to Gloria. I want to maybe take a step back. So we looked at Zambia in particular. Let's look at the issue on at the more regional level. Based on your experience and your analysis, do you think resource-rich developing economies in Africa in general should grant tax incentives to mining investors?
I feel like that's a trick question, Thomas.
It is a very trick question.
But well, let me start by saying congratulations for this great report. I think it really very well captures a very difficult notion, because I think, as Edward had said, there's the yes and the no to it. There's the benefits, and then there's the costs of it. And I think that because generally we sort of tend to take the stand that no, we don't want incentives, we sometimes do overlook the usefulness. And so to answer the question, I'll start from the usefulness of incentives. I think that they did not start off as being entirely bad. They're a good idea there. It's a tool. It's a very useful tool for stimulating growth in certain areas. And I think that we've sort of drifted away from that initial intention of them, which was really to find a way to grow extractives and increase that future gain from it. But instead, they've sort of evolved into this monster that's brought more costs than benefits. And so I would say that there is still room to consider incentives, but it's under very, very strict conditions. Now, basing on the report, I think we get to really understand what some of those loopholes are and how we can strengthen them if we're still going to consider incentives moving forward. First of all, I think we need to really consider that it has to be very specific. The initial intention is to create or stimulate growth in a particular area. And if the incentive does not consider what those benefits are, and I think the report really mentioned very well the idea of cost-benefit analysis. It can't just be blanket incentives. They have to be very specific. And so now when we talk about critical minerals, when we talk about green investments, these are things that can be considered as we're looking at how to design incentives. I think we've seen countries like USA and Canada that have managed to tailor very specific tax provisions that could actually, and incentives that could actually stimulate growth or investment in renewable technologies, for example. So now as we talk about increasing extraction of critical minerals, we can also consider the broader commitments that we have as a continent. Looking at the Africa Mining Vision, we're talking about regionalization, how we can start increasing beneficiation along the value chain. How can these incentives be designed specifically to stimulate those objectives? And I think that that's achievable because one experience we've seen from incentives is that they led to a race to the bottom. So now countries are competing with each other. But in the framework of the Africa Mining Vision, we're saying that we have to work together if we're going to realize more benefits from extraction. So as there's a wave on critical minerals, I think that it's really important to understand how we can tailor those incentives to work to a real benefit towards our objectives within that framework. Another issue to consider is also, I think, the idea of creating the opportunities for countries to mobilize resources. So if you look at incentives and we say that the costs outweigh the benefits, then you would say that it's pointless. But then the tax expenditures that we're foregoing, we need to consider how they can be redirected in a way that stimulates. We may not get it as tax, but it may actually be, we may actually realize gains from within this incentive framework that can be redirected to other sectors. And I think that this is also going to be a bit of a challenge as we also now consider how countries can respond to climate change response. So countries like Nigeria, for example, Nigeria has a climate finance gap of $29.7 billion annually. But if you also look at what they're losing in terms of taxes, it's a lot. So now countries need to start looking at really understanding what costs are needed for them to respond to climate change, for them to respond to the development needs, and then consider how much they're losing from incentives and try to find a balance within that framework. Because it doesn't make sense for you to be unable to meet your development needs when you're giving so much away in the form of incentives. So there's opportunities there to make those incentives translate into a different kind of collaboration with MNEs and investors. And finally, I think that there's also opportunity for us to consider how we can suddenly recover the externalities that the extractive sector have caused. And one thing we can look at is that incentives can also be used as a way for companies that are investing in especially critical minerals can actually help us recover from those externalities. So one thing that we've actually been doing as TGNA is also equipping parliamentarians with the ability to understand incentives and taxation frameworks, and giving them even a toolkit on how they can assess those legislative provisions on incentives and how they can really also be able to monitor for going forward. So it starts from as you're creating the incentives all the way to the enforcement of the incentives, and then to how you're able to now monitor the effectiveness of those incentives. And that means that you need to be able to go back and say, it's not working, we need to let it go. So I think those are very important conditions that need to be considered before incentives are put into place for any project. Thank you.
Thank you so much, Gloria. I like how you're moving the conversation from incentives, tax incentives generally speaking, to like more specificity, like which incentives, how can they be useful, under what circumstances, for what purpose, and going after with specific targets. I think that's a very interesting evolution, and I hope we continue on that line for the rest of the webinar. So we'll definitely come back to those questions and those outcome-based incentives in particular. But I'm going to turn to Kusai Mataba now. Kusi, I have a question for you. I don't think it's a trick question, but it's a difficult one. And it's a challenging one because you won't have the whole day to explain to us what is the global minimum tax. So I'm going to ask you to explain to us briefly what is the global minimum tax and what it means for the use of tax incentives in the mining sector in particular.
Good afternoon, everyone, and thank you, Toma, for that challenging question. I'll do my best in 5 minutes. So if I was to explain to you as simply as I can, what is the global minimum tax and what does it mean for the mining sector, I'll begin by maybe giving you a bit of the genesis of the global minimum tax, which has kindly been provided by both panelists already. So in about 2020, the OECD Inclusive Framework / G20, aware of this growing race to the bottom, the competition between countries to compete for investment through the provision of tax incentives, designed this coordinated set of primarily 3 rules that in their essence are designed to ensure that no multinational entity pays an effective tax rate less than 15%. So an effective tax rate is somewhat different, well, majorly different from a corporate headline tax rate. And how these rules would work in their essence is that wherever you have a large multinational entity that is paying an effective tax rate of less than 15%, maybe as a result of the provision of tax incentives and other tax provisions, then the headquarter company of this multinational entity will have the obligation to pay, to make this company pay the difference between what it pays in the host jurisdiction and 15%. So let's say, for example, in Zimbabwe, if a large multinational is operating there and paying an effective tax rate of about 12%, then the home jurisdiction of this company, let's say Switzerland or Canada, would then have the obligation to top up this tax in their jurisdiction. So topping up would be about 3%. So what that does in essence is create this floor to tax competition through the operation of these rules. So these rules don't operate on a global spectrum. It's up to countries to adopt the rules and to implement them, although the name may suggest otherwise. However, when we look at the mining sector, there are some nuances to the rules that may be of interest. So for example, firstly, there is a carve-out for tangible assets and payroll taxes. And this was done in order to recognize that tax incentives could have a role towards incentivizing investment in sectors that are highly capital intensive. We also see that these rules do not target all tax incentives. In particular, the rules are targeting the most harmful tax incentives, which we understand now to be profit-based incentives, less so cost-based incentives, and then we also have some tax incentives that are entirely carved out of the rule set, such as VAT and other property taxes. So you see that the mining sector will be impacted by the rules. However, there are these nuances that exist in the operation of the rules. And now I hope, having paid some justice to what is the global minimum tax, I can turn to what is the implication for the mining sector. So I would have already begun to allude that I think for the mining sector, this presents an opportunity to really rethink the use of tax incentives. It presents an opportunity for countries that for a very long time have been thinking that maybe tax incentives aren't the right tool, to use this opportunity to conduct some assessments into the impact of these rules. Some of the work we've been doing, Toma, at ISD, and particularly on our team, is helping countries with the economic and legal impact assessments that help them understand what's at risk. So how much revenue is the country foregoing by continuing to give incentives? And mining sectors in many developing countries are a key source of incentives, but also host many large multinational enterprises. So although these rules aren't designed just for the mining sector is particularly vulnerable, and we found can be a good partner or a good ministry through which a government can begin this more holistic review of tax incentives. So firstly, as I've mentioned, it's an opportunity to rethink the types, not only the use of incentives, but the types of incentives. I think Viola went through the difference between cost-based and profit-based, and many of our studies show that cost-based incentives may be more applicable and more attractive in the sector due to the number of characteristics of the sector. So I think that would be the starting point. And also, in conducting this legal and economic impact assessment, even though we could look at, what is the revenue loss for the mining sector, just this overall review of tax incentives is really good fiscal policy for national agendas in general. So I think my 5 minutes should be up, and I hope in the next session, I can speak a little bit more about what we're doing and what more countries can do. But I think the bottom line is that it's really an opportunity to be evaluating the impact of incentives, and we have various platforms through which we can provide technical assistance to countries, as well as very developed resources that help you go step by step, understanding which companies may be receiving the incentives that are most at risk, how much money, revenues at risk as well, but also what are the legal constraints of beginning to unwind these incentives. Thank you.
Thank you so much, Kruti. I thought that was very clear, but I know it's a complex topic, so I invite everyone who needs more clarification to send us a question on the Q&A, and we'll come back to any point of the workings of the international of the global minimum tax that may not be fully clear. But I think it's a very important point to attract everyone's attention to the interaction between domestic tax policy and international tax rules. Countries don't operate in a vacuum, and tax policy can interact with tax rules in other countries and undermine the effectiveness of whatever, as a policymaker, you're trying to put in place in a given country. So it's important to take into account not only the global minimum tax, but other similar payments that have been created in host countries. So the US has its own version of a global minimum tax, and both the US, European Union, and other countries have a controlled foreign company rules that also tax untaxed income in that maybe in other places in the world at the level of the headquarter jurisdiction. So it's important to take that into account, and as you would think, the effectiveness of tax incentives and the way what is available to investors. Definitely. Thank you so much. I'm looking at I don't see any immediate question from the audience, so I think we can go ahead with the second question for each of you. In the meantime, I invite again participants to ask questions. So I'm going to come back to you, Edward. Thank you so much for sort of the background on the mining policies in Zambia and how the government have been trying to attract investment and the cost and benefits of incentives. I think what will be interesting also for participants to hear is what Zambia has done to change, improve, adapt its tax incentives regime over the years, as a lessons possibly to other countries that may want to follow your footsteps in terms of these reforms.
So thanks again. So I also just give you a background. What is happening in Zambia is that we have a new government that was voted into power in 2021, led by His Excellency, President Hakainde Hichilema. And you'll be interested to know that the president has been very, very interested in the mining sector. And that has to do with his background, as a business, guru and all that kind of stuff. So I think in 2022, we had a new policy, which has given birth to two things, which I'll be able to explain. So, Zambia is the second, highest in terms of production of copper in Africa. and yet, the mining sector was not regulated, by a Minerals Regulation Commission. So we undertook to, establish what we're calling the Mines and Minerals Regulation Commission, that now gives birth to all the corners of the country. So that's the first reform that we have done. What will that do? It will increase compliance in terms of these companies evading the tax, monitoring their production, because I think we had a problem also of misreporting, which then made them to under-declare what they were producing. But also, what we've done is to ensure that there will be enhanced monitoring and monitoring and evaluation of the mining companies, to ensure that we monitor what they are producing, what sort of minerals they are producing, for compliance sake. But also is to encourage them to report, and cartel, what Viola was talking about, that is transfer pricing. What will that do? The Minerals Regulation Commission will work hand in hand, with, the Revenue Authority, and there are systems that have been developed to ensure that from the mining gate, the tax, Revenue Authority will be able to know the production, because this, the Minerals Regulation Commission is widespread to all the places. Yes, we've given tax incentives, as it were, but we are trying to ensure that we enhance on monitoring and compliance for the mining companies to report, what they're producing, and ensure that they pay the fair taxes, in the sector. And that is going to increase so much because, as you may be aware, if you read about Zambia, we are running what we're calling the geological survey, the area geophysical survey. Zambia is only mapped up to 54%. We want to map the country 100%. And what we are, seeing is a lot of minerals. I think other colleague of mine spoke about, Gloria spoke about, the issue of geological information, and even Viola spoke about it. So what we've seen from what we are getting the results is that we may have a lot of, investors coming through to Zambia to, participate in the critical mineral subsector, which we have in abundance. But even as we give incentives, what we have tried to concentrate, and probably this could be one of the resolutions, in your meeting, is that when we give these tax incentives, don't bring, employment in terms of, basically trying to ensure that you're just getting the raw copper. We can keep tax incentives through encouraging these companies to do value addition in country, because that then creates real jobs. It creates real business opportunities, for the local people. It also creates, more value on the products that will be value added to be taxed, so that then retains revenue to, the government. So what has the president and the ministry done is that we have said, for example, that we are not going to export, raw materials in terms of the critical minerals. President, the Ministry of Mines, we have come up with the critical mineral strategy, where we are saying, if you have to invest in this particular sector, yes, we may lack technology, we may lack the skills, we may lack the finances that may be required, but let us not repeat legacy problems. And we can only do that by ensuring that as we give the tax incentives, as clearly indicated, which may be good, we may retain much of, the things that are needed in the minerals value chain, so that the production, the value addition is done in country. Then we are going to retain much of the benefits. There's a lot of things that we can talk about, but lastly, let's talk about what we're calling the local content. So, for example, we have said in the local content regulations, which if you want to look at what we are proposing as a country, you can get in touch with me and I'll be able to share with you, because I'm the one that is working on it. Is that we are saying anything below $1 million, any business that will be below $1 billion will be given to a Zambia. Okay. And then we are proposing that all non-mining equipment, for example, will be supplied by Zambians. Groceries, gym, medicines, and all that kind of stuff will be supplied by Zambians. But also we are talking about some core mining goods that should be supplied by Zambians. All that is to be able to retain what we are giving away, in terms of tax incentives, to be able to come to Zambians for purpose of creating job opportunities, for the Zambians. It's a big discussion, but I think we are moving towards ensuring, and this is my last point of what Viola spoke about. She said, and I heard her right, she said, look, you have to first of all analyze, before you give these tax incentives, what value are you losing and how you can recover it. Okay, so in this country we are asking ourselves, what value are we losing by giving these tax incentives to the mining sector? How can we recover it? One of the ways in which we can recover that is through local content, ensuring that the businesses, small businesses in the Zambian space, are capacitated to be able to supply the needs and wants of the mining sector. So it's a concoction of a lot of issues, but I think you'll be interested to know more of what is happening in the Zambian space. But because of time, I will submit at that particular point. Thank you very much.
Thank you so much, Edward. This is really interesting. I think these are really valuable lessons. And I think you've answered, I'm seeing some of the questions now from the Q&A. I think your answer also answers the question from Mohammed Adan, who's asking, is from a country that hasn't developed mineral resources yet, and so he's asking how some of the if the lessons are applicable to them. And I think what you shared here should be very interesting for him, as he thinks about how to design incentives for investors in the mining sector, as to not lose too much of the value of the minerals, but perhaps at least achieve the goals that the government is assigning. Thank you so much. So now I'm going to come back to Gloria, and so we discussed. I'd like to follow up on the points you raised earlier, especially around how tax incentives, what role tax incentives have to play in sort of the new era of mining. But in particular, there are I see in the Q&A specific questions around certain types of tax incentives that are based on specific policy goals. So one of them, a question from Mr. Kumar, around asking if there are tax incentives based on sustainability and climate. I think that would be an interesting point to raise, to go deeper on. And then there's another question from Monsieur Awidad around, sorry, from Mayonje around what types of tax incentives can promote value addition in the mining sector. So Edward just touched on that. If you have other examples or other recommendations, I think that would be of great interest to participants as well. Thank you.
Right. So I think that there's absolutely no role for tax incentives as they have been done in the past in this new era. So if we're going to keep doing it as it has been done, then perhaps it's something that we should consider as not a useful tool for us. And so right now, there's a lot of things happening. Countries are responding in different ways. For example, we now have the CBAM, the Carbon Border Adjustment Mechanism, being implemented in the EU. If you provide incentives in an African country and then you find that you actually cannot even export that product because there are implications through the CBAM, that actually means that you are not going to get the full benefit of those resources as a country. So you won't even be able to access markets. So if our focus is simply on getting the investor to come and not thinking about the context in which we're operating, the context in which we would want to market these products, I think it's going to make it very challenging for us as African countries to realize any gains from extractives at all. And so because of that, I would say that if we enhance the administration mechanisms, it would make a very big difference in how countries can actually move towards a concerted goal. And that's, I think, specifically looking at for example, incentivizing development of specific economic zones as it is in the Africa Mining Vision. And that would be a huge opportunity for us to make certain areas more amenable for certain kinds of investments through those incentives. And the AMV does a really good job of, I think, creating those industrial kind of zones where you can see what countries can do value addition, what countries can focus on extraction. And I think that would really be a good way of using incentives to develop those particular zones, those particular areas and industrial goals. So there is that opportunity if we do it in a concerted way within regional context, within a continental context, that would actually make a huge difference in allowing Africa to benefit from its resources, but also move more clearly towards a low carbon future. Another thing is that there also has to be a good flow of information if we're going to have incentives. You can't develop incentives if you don't have the right information, because you're making decisions and foregoing revenues without even knowing what you're actually foregoing. So those information asymmetries, those need to be eliminated if we're still going to look at a future for incentives. And I think the EITI has played a very key role in facilitating that flow of information, where you're actually now able to access information to analyze what kind of incentives can be considered. And the good thing about the EIT is that it's constantly evolving, in that the reporting requirements can be adjusted based on what we want, what countries want. And so that opportunity, I think it can be utilized to really develop incentives that align with our goals and based on the information that we have, for us to have the right kind of information. And then, of course, the strengthening of governance will also be very key if we're going to continue to bring in incentives. And I say this because IFFs have come out largely from incentives, and Viola mentioned this, that they do create a very potent ground for illicit financial flows. And if we're going to continue to provide these incentives, especially now with the rush for critical minerals, it means we're going to make even more losses. And so we need to strengthen those loopholes. We need to find ways in which regionally we can actually administer these incentives together. But also, I think now, as we consider the global tax treaty, there's opportunities there to redefine what those incentives can look like in a way that also incorporates the externalities as I had mentioned earlier. Malonje's question, I'm trying to go back to it. So he's talking about tax incentives that can focus on in-country value addition. And actually, the AMV focuses on that a lot. It actually tries to create new avenues that can actually encourage industrialization, that can look at more value addition in a way that's not just about increasing the revenue base, but also allowing for us to actually realize tangible beneficiation, where we can actually see benefits in terms of technologies, industrialization. So these are things that we're missing out on when we forgo that revenue, but then we can find ways to recover them within this framework. And it has to be at a regional level. I think this is something that we often take for granted. No one country can do this on its own. It really has to be at a regional level and at continental level if this is going to be effective. Otherwise, we'll still find ourselves in this race to the bottom, and that continues to disadvantage us and create more loopholes for IFFs. What other question did I miss? I could come back. I know my 5 minutes is up, but I could come back and respond to some of the questions as well.
Yeah, I think we'll come back to question. There was one around if there were any tax incentives based on sustainability performance. That's another one that I think of interest. If you have an answer now, feel free to add. Otherwise, you can come back to this in a minute or two.
I think a really good example, and Edward can correct me, I think he mentioned this, but I think some of Zambia's incentives can actually be tailored for this. For example, I think it's capital allowances. These are things that can be tailored for green industrialization as well. So this could be some of the ideas. I don't have any specifics in Africa, but I also know that countries like Canada have, for example, incentivized extraction of green minerals or investment in green infrastructure within the extractive sector. So this is looking at longer term, where you're incentivizing industrial development that is also low carbon, intensive, and that could then continue to benefit the country even long after the companies are no longer operating in that specific area. But I think that there is a really good example from Zambia that I would hand over to Edward to maybe elaborate. And I think he talked a bit about that.
Thanks a lot. Edward, do you have the example in mind, or otherwise we can progress on the discussion?
Yeah, I think we can progress, but I'll be able to tackle it just in a minute. Yeah.
Perfect. Yeah, thank you. And you can share it also in the chat if it's easier. Thank you so much for this and for the questions. And thank you also, Gloria, for raising the point about regional cooperation and harmonization. It's very important, I think, for them to address the issue. Often companies take advantage of perceived or real competition between countries to attract investment. And so moving as a group will help to be stronger in terms of setting a minimum level of taxes that are expected. There is a good example in West Africa. The West African Economic and Monetary Union passed a regional mining code almost 2 years ago. And part of that mining code includes the sort of like the standard fiscal regime that would apply to mining companies. And it severely limits what's feasible in terms of tax incentives. And because that law has like a supranational characteristics, it supersedes domestic laws as well. So that's kind of forces regional harmonization on tax incentives. I think that's a good example that could be followed in other parts of the continent. I'm going to turn back to you again, Kuti. You mentioned that you had worked on supporting some tax incentives reforms in various countries. We heard from Gloria and Edward how important it is, but also like it's not an easy process. So I'm going to ask you, based on on your experience, what have you identified as the key barriers preventing tax incentives reforms in resource-rich countries?
Thank you for that question, Taman. Once again, I think this is another one where we could be here all day, but I'll maybe limit my intervention to 3 main points. And when I was preparing for this question, it reminded me of a few months ago, we sat down with about 60 investment policymakers from around the world at the annual investment policy forum held by ISD and asked them this exact question, And what we learned from them is that there is very wide and broad understanding of the limitation of incentives, as we've discussed here and on other forums. So tax incentive reform, I think, in my perspective, is not as a lack of information or a lack of education amongst investment policymakers or tax officials, but rather, I think, more concrete and real problems faced. And on the other side, when we speak to mining companies, many of them express to us that they would be happy to pay taxes in the jurisdictions in which they produce their minerals. They also speak to us about how tax is only one element that they consider when making investment decisions. So clearly there's what we hear and see, but what we continue to see despite this information is that tax incentives continue to proliferate, particularly in resource-rich countries. And if I was to group some of the reasons we observe into 3 categories, the first one I would begin with has to do with institutional gaps. And I think this speaks to something both Gloria, Edward, and Viola have spoken about. Our countries having a clear understanding to begin with of what are the incentives they have in place, where are they found, who are they granted to, or for what duration. So it's really difficult to reform a monster you don't understand, per se. So in many countries where we work, the very first piece of important work is that to understand what is to create the data, what are the incentives. And because they're held in contracts, which are often opaque, they are also held in agreements that are archaic and come back from many, many years ago. It's really hard to collate this information and to understand it, to use it as a tool for reform. And also this lack of information, this opaqueness of contracts where the incentives are also makes it very difficult to monitor them. So to evaluate which ones. So I think we've agreed that, some incentives may have a role to play, but it's really difficult to identify which ones are ripe for a reform if there has been no effective monitoring and evaluation of these incentives. So we see that as a challenge. And then lastly, as the fragmentation of role players involved in granting of incentives. So if we think of the mining sector, in many of the countries we work in, the Investment Promotion Agency will have the capacity to grant incentives to the mining sector. The mining sector itself has the prerogative to grant incentives, and there really isn't communication amongst these role players as to which incentives are being granted to who and which sources, how and for how long. So I think those are the sort of institutional challenges that we see. And although there's several guidance, for example, from the Platform on Collaboration on Tax, the PCT, as well as the OECD, many countries find this guidance or frameworks very difficult to implement as a policymaker, to sit down with these various sources of policy and coordinate and create a coherent reform package of incentives. And that's something at ISD we're trying to tackle at present through the creation of a framework on the investment of incentives. And then if I was to turn to what I think is the second most challenge, that would be to do with legal and contractual challenges. So I think we spoke a bit about, for example, stabilization clauses, which are these clauses that are set to freeze in time fiscal conditions, either for a certain duration or forever, depending on the country and how they designed these. But what we've learned over the past, I'm sure, 10 years is that what we know about the utility of stabilization clauses is changing. A few years ago, the OECD came out with the principles for durable contracts, which began this conversation about the changing role of stabilization clauses, questioning if they continue to have a role within the mining sector and investment more broadly. And I think we've been slow to adapt some of these principles. So we see some countries continue to grant stabilization clauses, which make it really difficult to effect the sort of reform we think is important. And also in some of the countries we work in, there is also a hesitancy to relook at contracts. So there's a hesitancy to renegotiate contracts, which is a real fear, because opening up a contract could mean new topics are brought on the table. But sometimes there is legitimate reason to reopen these contracts. Some companies have shown leniency towards looking at stabilization clauses. So the risks are there, but there is the fear of even touching contracts and beginning to try redress some of these errors made in the past has made reform of tax incentives very difficult as well. And then lastly, I would call it the political economy of reform of incentives. And here there's, I think, almost a mixed bag of issues that we see as real challenges. So for example, incentives, unfortunately, are very politically charged. We see in many of the countries we work in, as we approach election cycles, governments are very keen to be seen to be working hard, which they are, and to be attracting investment, which they also are. And incentives tend to be seen as an easy tool that can be, used to attract quick wins, if we can call that, and often without the repercussions being felt today. So often a government that gives a 10, 15-year tax holiday won't be there in 10, 15 years to account for what that holiday has seen. And there, I think we see, as Gloria mentioned, the role of Parliament to really provide an oversight role and also to really enforce the sort of monitoring and evaluation of incentives. I think in this mixed bag of political economy, there's also just the path dependency. And I think Edward spoke about that. Companies want incentives because they've always gotten incentives, and companies don't want to give away their incentives because they've always had incentives. And we lead ourselves with this path where there's no real reason to give them other than that it's become common practice. It's almost when we begin negotiations, incentives have to be on the table. And a part of that is just rethinking the narratives, I think. And then obviously they're the more, not obviously, but then they're also the darker side of it. So, the rent seeking that comes along with tax incentives and makes it very difficult, because in some of the countries we work with, ministries or ministers are given very high discretionary powers to grant incentives. So whilst the Ministry of Finance is unbundling and reforming incentives, you have high-level officials who have the ability to give incentives at their discretion. And I think these issues almost come down to governance issues around incentives, but I don't think should be underlooked. So they are technical. I think they are, the hard challenges to reform, the stabilization clauses, the legal contractual challenges, then they're the more governance and I think softer issues around coordination, as well as ensuring that there's an oversight role to the granting of incentives that can also then inform future reform. So without, I think, belaboring this point anymore, I'll pause there and hope we can maybe unpack later or in the chat box. Thank you.
Thank you so much.
Can I just tip in? I think I just wanted to contribute to the point that she has spoken about. And I think that's the political...
that might be our last point, but go ahead, yeah. That's very
Yeah, so the political ramifications quickly, I think under a minute. So you see, the government or the governments in Africa have a biggest problem, and the biggest problem is to balance the social needs of the people as well as the income. Now, if you are dealing with financial, the incentives that we're talking about, mining incentives, for example, in the Zambian perspective, you're having a president who, on this other hand, is being told that we need employment creation. You also having a person who is, being told to say we need, the mining sector to give us what we need as Zambians, employment creation and all these things. And for you to create, employment, you have to forego, you have to give incentives for these people to come in. And also, the same person now is also having another pressure from these, mining companies that come to invest, saying, look, you have to give us tax holidays. Now, the same person again has to provide the goods and services, the public goods. In economics, we call them public goods, health, education, and all that kind of stuff. And they need the money. So now, that is a mixed bag, and this is what she's referring to. How do you balance those things? Need investments to create employment, but you need the money again to provide public goods and services. And probably, in the report that Viola gave, I think that aspect should come out. How do African nations, how do these countries that have got the extractive industries that are the bread and butter of the countries, how do they balance that mixed bag that the previous speaker spoke about? I submit.
Thank you so much, Edward. And I think those are strong words, I think, to end our webinar. It is true that African policymakers are in a very difficult position when it comes to making these decisions. These are trade-offs, and there are a million demands on their time, on their million priorities to address. So it's really difficult to find the right balance. The best we can hope is maybe in terms of incentive, to move to a vicious, to move out of a vicious circle and into a virtuous circle, in which fewer tax holidays or overly generous tax incentives allow governments to have more revenue, and then invest in public goods that then attract more investment, and so on and so on and so on. But how to get into that virtuous circle is itself a difficult question. So at least we can count on all these experts who join us today, who are all very passionate and motivated to help. So I really value everyone's time and contributions. I think this is just part of the conversation, and this report hopefully is contributing to the question, but we'll come back to this in many other events and publications and working as a coalition, hopefully. Maybe to also end on a note of optimism in terms of building coalitions and working together, I would just note that the 4th Financing for Development Conference just ended in Sevilla a couple of weeks ago, and interestingly, all nations, except the US, all nations except the US agreed on an outcome document from this conference that will lay out the landscape for financing for development in the next decade. And one important point in the chapter on domestic resource mobilization is the importance of fair taxation of extractive industries. It is seen as a key sector for many developing nations, and so it's important to make sure that companies in the sector pay their fair share of taxes, and that governments don't give away too much in terms of through tax incentives. So that was highlighted in that document. And the importance also of rationalizing tax expenditures was also key in that document. And several initiatives were born out of the conference to look specifically at how can we reform tax incentives for the benefit of host countries. So there's a coalition that ISD is part of with other organizations. I know ATAF also has interesting contributions on this topic. TGNA also quite present. So we'll be working on this together as a coalition, and I encourage everyone to stay in touch and to reach out to us, to UNICA, to TGNA, to other partners, if you're facing these issues in your country and you like to work together on addressing and reforming tax incentives. With that, I will thank you again and say wish you a good rest of the day, good rest of the week, and I hope to see you all again soon.